The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Does the bull market deserve the benefit of the doubt? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. and it looks good so far on this Monday. The S&P 500 up by more than 1% right now with an hour to go until those bells. Big tech leading the action right now. The NASDAQ 100 higher by 1.4%. You're seeing maybe a sigh of relief come through the bond market, but still a bid pushing the 10-year yield below 4%. And then take a look at what's going on in the VIX, dropping for another day, Romaine. We are back below 20, back below 19 even.
Absolutely. Almost that spike we saw over the last few days, a thing of the past. And for anyone last week wondering about the durability of this bull market, today's session and Friday's, they're giving you an answer. The strongest two-day rally for the S&P and NASDAQ since June is economic stability, AI infrastructure spending, and a retail crowd that's keen to buy those market dips, all that combining to extend the bull market into its fourth year.
I'm very bullish. I think the market goes to new highs before Thanksgiving. There's one simple reason for it. It's easy money.
Yeah, maybe it is easy money and as easy of a trade as the public markets have provided. The risks, though, are mounting. Individual investor sentiment is still subdued. Institutional money managers are doing more hedging than buying. And Deutsche Bank data shows overall equity positioning tumbled the most last week since April, from moderately overweight to neutral, with discretionary investors moving from neutral to notably underweight. Morgan Stanley's Mike Wilson, in his weekly note, also flagging unresolved risk around trade tensions that he says could knock as much as 11% off the S&P if the U.S.-China tariff spat isn't resolved next month. But to be sure, he is still bullish on economic fundamentals, and other strategists see a feed-through from that into corporate fundamentals as earnings season ramps up, with notable reports this week from Intel, Netflix, Tesla, Ford, and Procter & Gamble.
Well, it's interesting, Romaine. You are seeing some caution come through when it comes to the outlook for earnings season. You're taking a look at Citigroup data in terms of the revisions, earnings revisions heading into really the heart of earnings season, as Romaine just walked us through. For a second week, you've seen those revisions actually come down. We had a really nice streak where we were getting revised higher and higher. Now, 2 straight weeks in a row. We haven't seen that really since the mid part of this year. I will say we have seen the companies that have reported earnings so far, 85% of them have beat on profit estimates, but it's still early yet, Romaine, and we know the big guys are taking the stage this week.
Keith Lerner joins us right now to kick us off to the close, Chief Investment Officer and Chief Market Strategist at Truist Advisory Services. And Keith, there's been sort of this idea here that we've gone well past the idea of FOMO here. I mean, this is a market, a bull market, we should say, that has kind of been left to its own devices. And I'm curious if you see any potential cracks that could actually, if not bring it to an end, certainly curtail it.
Yeah, well, first, great to be with you. You know, I think our main point I'd say up front is we still think this bull market deserves the benefit of the doubt. There's always potential cracks. We had some concerns last week around the credit side. There were some concerns about sentiment. But in a bull market, you climb this wall of worry, and that's what we're seeing again. And, one thing you want to see is actually when a bull market gets hit, how quickly it comes back. And we're getting our answer today. In our view, the North Star of this bull market has been profits. So I think it is important with valuations where they are today that earnings come through. As Katie mentioned, I mean, we're very early into this earnings season, but we are beating at about an 85% clip. So that's actually better than normal. We want to see that continue. But all in all, especially as we just turned 3 years old, the history is on the side of this bull market continuing, even if we have some bruises along the way.
Are you relatively optimistic, Keith, about this earnings season and what we're actually going to hear, particularly now that we're getting into the heart of it with the biggest companies in, of course, the hottest sectors?
I am. I mean, I think the biggest risk is that expectations are somewhat higher. I know Katie just showed that we're seeing some revision hits more recently, but into this earnings season, what was unusual is that analysts actually raised their estimates into the earnings season, which is unusual. But all in all, as I think about this bull market, and we've had all these different narratives from inflation, interest rates, tariffs. Again, the North Star has been profits, and each time companies have come out the other side somewhat more resilient. And we're seeing forward earning estimates for the S&P at an all-time high. We're seeing that now broaden out to the eco-weight index and small caps. So, yeah, is there some risk of high expectations? Yes, but ultimately, as long as earnings move forward and we think they will, the market should be supported. And lastly, we're actually anticipating a slight uptick in economic growth over the next year, and I think that should also be supportive of profits.
Well, Keith, let's talk about one of the other things that really spooked investors in the past week and a half, and that is what we saw in the credit markets. Of course, the feed through we were seeing from that into some of the regional banks, especially. You saw an interesting note out from Bank of America this morning saying that we could see some forced stock selling from long-only accounts if we see credit problems persist. And Keith, I wonder what you make of that daisy chain between the different asset classes and how many dominoes there's still left to fall here.
Yeah, it's a good point. It's a risk we should be monitoring. I think a lot of what we know in the private market is it's somewhat opaque. But I will say, if you think about last week, it was really a tale of two, markets as far as the financial sector. We had a lot of the big banks come out and they were talking about, improved credit quality, an economy that's resilient. And then you had some of these kind of one-off situations. From what we see so far, and again, I want to keep an open mind to this, but so far, it does not seem like something systemic that we're seeing across the economy, especially, again, mentioning that these bigger banks, which are the dominant lending force for this U.S. economy, are still showing some resiliency. We also saw a company like American Express talking about at least the high end still holding up relatively well. We all know, just like I talked about the banks, it's a two-speed economy for the consumer, but the high end at this point is still holding up relatively well.
A two-speed economy for the consumer. I do like that phrasing. Well, you point out in your notes that you take a look at small cap financials, for example. They've plunged over 10% from their recent highs. Keith, against that backdrop that you described, is that a buying opportunity or is that somewhere that maybe you would stay away from here?
I don't think it's leadership yet. I think it will participate, and maybe things got a bit overdone last week. With small caps in general, financials and industrials are bigger components of the small cap indices relative to large caps, which are much more dominated by growth and technology. But I do think it's a healthy sign that you are seeing a rebound today. Again, I don't think it's leadership. I think the leadership is still with the larger banks, so we would stick more there within financials. And then more broadly, I do think there might be some catch-up potential with small caps because they're so underloved, but the structural AI theme still stays with large caps, and we've been overweight tech and communication services this year, and we remain so because we still think that's the dominant theme of this bull market.
I am curious, Keith, just about kind of the interplay with kind of what's going on globally, not just with trade, but the idea of the weakness of the dollar and how that feeds into the U.S. equity trade, whether you see that persistent, and whether there is any real argument to make for diversifying geographically outside of the U.S.
Yeah, well, it's interesting because right now, if you look at year to date, emerging markets and international developed markets are really being the U.S., but that really came in about, 2-month span. And a big part of that was the dollar. If you think about the outperformance this year, the U.S. dollar has been about 10% of that for international markets. But what you're seeing more recently is that U.S. dollar is starting to stabilize. So going to your question, listen, we're still Team USA. We still think the fundamentals, the innovation is best here, but we still think it also still makes sense to diversify. Look at today. You're seeing Japan make fresh all-time highs. A couple of weeks ago, we were talking about France and all the geopolitical issues. Well, that market is close to back to new highs as well. So, and then also emerging markets, as I mentioned, fresh highs. So I think what's actually interesting about this market is not just either or, it's both. We still lean more with the U.S., but I think you still want to have exposure to some of these other markets. And it's still a hedge in case the dollar, weakens against at some point later this year.
All right, Keith, got to leave it there. Keith Lerner, Chief Investment Officer and Chief Market Strategist at Truist, kicking us off to the close with stocks near session highs. When we come back, a look forward. JPMorgan out with its flagship 2026 long-term capital markets outlook, a conversation, a sit-down with David Kelly and Stephen Parker in just a second.
And from long-term forecasts to luxury listings, Ryan Serhant joins us with his read on Manhattan real estate and whether the Big Apple's market is ripe for the picking.
Puns, high rises to high seas. How about that for a pun, Katie Greifeld? Royal Caribbean Chairman Richard Fain, the man who led this company for more than 30 years. He's got a new book out about the lessons that he learned in business and, of course, in keeping the cruise line sailing. All that and more coming up in a bit. This is The Close on Bloomberg.
Rare earths, fentanyl, and soybeans, those are the key issues on the table as President Trump prepares to restart trade negotiations with China. Now, soybean prices hitting their highest levels in a month, with investors optimistic that the talks, which are set to kick off this week in Malaysia, could ease tensions between the two global superpowers. Joining us now is Jeff Moon. He is president of China Moon Strategies and former assistant U.S. trade representative for China. Jeff, great to have you back with us. So a crucial stretch here with these meetings. What would success look like coming out of them for the U.S. and for China?
Well, I think the most important thing is that we get some kind of detente between the two countries where they stop sniping at each other and making threats and then backing off and going back and forth. I think business craves some kind of stability. And so I think that's what we're really looking for. In terms of more specific things, I think we're going to get very modest deliverables. We're not going to get some kind of a grand deal. But the elements are that China wants decreased U.S. tariffs. They want reduced export controls. They maybe want U.S. investment opportunities. And the U.S., as you mentioned, wants rare earths, fentanyl help, and market access for soybeans and other products.
And Jeff, I mean, heading into this summit, and it remains to be seen if we'll see the leaders of these two countries actually meet, what do you think is the harder conversation or the more delicate conversation here when it comes to some of these non-tariff measures, rare earths, soybeans, fentanyl, et cetera, or the actual outright tariff levels?
Oh, I think it's clearly rare earths. Rare earths has really changed the game. China now has leverage that they never had before. And they're determined to exert it in a very aggressive way. I mean, I think that we're on the verge of a new era, really. I think that China is going to start spoon feeding rare earths to the U.S. and other countries. And I think that they're going to use that leverage in a variety of ways, not just in trade. Whenever they're displeased, I think we're going to hear more about rare earths. And the question is, how far are they going to drive that, and how are countries going to respond? There are, on the tariff issues, there are pretty clear solutions or outcomes that we can arrive at. Trump wants to, I think he said he wants to reduce the tariffs, and fentanyl accounts for 20% of those tariffs. And it looks like there may be some way they can find an accommodation. So I think those kind of terms they can arrive at without too much difficulty. But the monopoly on rare earths is something that we're going to talk about for many years.
Absolutely. And I am curious, though, Jeff, too, with regards to some of the other issues, there's been a lot of discussion about China's focus, the more inward focus, particularly when it comes to technology. And I do wonder how this complicates any negotiations. I mean, I feel like if you had these negotiations 10 years ago, China had a certain need to be partnered with the U.S. on a lot of these things. And it seems like right now, and you can correct me if I'm wrong, they seem to be telegraphing this idea that they don't necessarily need us, at least not to the same extent that they did in the past.
Maybe not to the same extent as in the past, but I think a lot of this commentary about how we don't need you anymore, you need us, that's a typical Chinese negotiating technique. They want the chips. They want the high technology they know about, and they respect the fact that the U.S. has a lead in artificial intelligence and in other areas. And they're telling us that it's important because right now they're having their fourth plenum meeting in Beijing where they're pondering their annual 5-year plan. China tells us in its 5-year plans what's important to China. And the most important thing is technology. So I discount a lot of this commentary and think that that's a way to try to drive a bargain more easily with the United States.
What about China's financial situation? And I mean that more from the perspective of internationally. I know that they've had ambitions to make the yuan much more of a standard bearer for the globe, and I know they're a long way from that. But when you look at the weakness in the dollar, and more importantly, the U.S.'s seeming embrace of that weakness, does this give China an opportunity to maybe push a little bit harder on its own currency valuation?
Well, China's problem is that its currency is not convertible. So, yes, they can try to de-dollarize, but until they do something about the fundamental problem, I'm not so sure that things are going to change all that much. And, this has been an effort of many years to promote the yuan overseas, to promote digital currency. This is a recurring theme. I think we're talking about it more during the Trump trade war because of concern about bonds and some of the U.S. debt. But this is a longstanding issue.
And Jeff, before we let you go, we spoke about rare earths. I wanted to talk in a little bit more details about soybeans, because Bloomberg News has reported that you take a look at U.S. farmers, which are, of course, key to Donald Trump's support base, that they're running out of storage for their unsold beans. They're facing pressure from these lower prices. And I just wonder, how much of a point of leverage is that for China, that threat of whether or not they're going to buy these U.S. soybeans?
I think it is a major point of leverage because purchases by the Chinese of soybeans used to be mandatory until the Trump 1 trade war, and the threats of that trade war drove the Chinese to seek and encourage other suppliers like Brazil to make up the difference. Well, now those countries can make up that difference, and the trade deal that we may see in Seoul coming up could include some element of soybeans, but if it did so, it would be the Chinese seeing themselves as doing a favor, because they have developed alternative supplies in various different countries.
Jeff, really appreciate it. Jeff Moon, former assistant U.S. trade rep for China and president currently of China Moon Strategies. When we come back, we're going to turn to the regional banking sector, a rebound today after last week's sell-off. We're going to talk to an analyst who covers the sector and get his thoughts here on what the long-term outlook looks like. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Katie's favorite, Lululemon. BNP Paribas, which had a sell equivalent rating for more than a year and a half, upgraded to neutral from outperform. The analyst says the recent sell-off priced in a lot of bad news, and while the negative catalysts are less clear, the brand's partnership with American Express could be a key positive. The shares staging their strongest two-day rally since mid-August. Up next, Progressive. Morgan Stanley downgrading the insurer to underweight, cutting the price target to $214. The analyst sees cause for concern after the latest earnings report, saying a rebound is, quote, far off. In the bull case, less apparent. Those shares now at their lowest levels since August of last year. And finally, Corvo. Mizuho cutting to underperform and trimming the price target to 75. Mizuho also reducing its recommendation on Skyworks, saying that the two companies, both suppliers to Apple, face a tougher outlook due to softening iPhone demand. Nevertheless, the shares getting a modest bid today, as we did get some positive news on Apple, which today is rallying to its first record high of 2025. Those are some of our top calls. We do want to pivot now to what's been going on in the regional bank space, recouping some of the losses after plunging last week on the news that Zions and Western Alliance were alleged victims of fraud. Investors now waiting to see if Zions will actually provide some additional insight when it reports after the bell tonight. Christopher McGratty joins us right now, Managing Director and Head of U.S. Bank Research at KBW, a Stifel company. All right, Chris, let's get right to it here. I mean, I understand that what we heard from these companies last week seemed relatively minor, though I can also understand the alarm by investors. And I am curious, based on your own research and what you know, is there any sense that what we learned about last week is the tip of the iceberg or pretty much the whole iceberg?
Well, thanks for having me back. I would say this is part of the credit normalization process. The challenge is we've had three not so subtle reminders in a matter of weeks about credit, and banks can't lose money extending credit. But if you take a step back, bank balance sheets are in a terrific position. Capital levels are at record highs. Balance sheets are liquid. And really, the quarter that we're seeing unfold from a fundamental perspective is showing a lot of positive signs.
When we talk about this idea of loan loss reserves or other sort of metrics that we look to see what the health of that consumer, or more importantly of the borrower, is, anything there that gives you concern, Chris?
No, I think from a consumer perspective, employment is still pretty strong, so that's a good sign for the consumer. Commercial losses tend to be higher in certain asset classes, but again, nothing that we're seeing is outside of the realm of normal. I think what's caught investors off guard is that this has seemingly come out of nowhere. But overall, we think credit quality, we think Zions' numbers that we'll see in about an hour, they're going to be generally good absent this one credit.
Well, that's exactly where I wanted to go. So Zions, as you mentioned, we're expecting those results in about an hour's time. Certainly looking forward to that. This is a stock that you are market perform on when it comes to your rating. And you take a look at how it's performed over the past week or so. It got absolutely hammered last Thursday. It's rebounded a bit. What do executives need to say? What tone do they need to take to sort of reassure investors about where they actually are and what their books look like?
Sure, I would put a context into what's happened over the past week, as you talked about, Katie. Zions has lost $500 million in market cap, and the loss that we're talking about is $50 million. So it's a 10-to-1. That's a pretty, I think, big overreaction. But again, on the conference call, we're going to ask about when did we discover this problem? Was there something they could have done differently from a control perspective? Or was this, frankly, just fraud? And so I think what we're going to get is a lot more details. We're going to get a lot more details from Western Alliance, I think, this week as well. And I think they're going to put their best foot forward and talk about how they are a lot less risky than what the market thinks they are.
Absolutely. Well, we'll get that detail, at least from Zion's, in about an hour's time, breaking it down here on the close. But, Chris, I like the way that you section your coverage, because you have universal banks, then you have the large regionals where you say you need to be selective there, and then you have the banks with a market cap of about $50 billion to $100 billion. So certainly on the small side there. But this is an area that you actually like, and I'd like to hear why, especially as some of these credit concerns percolate.
Sure, and just as a firm, we're overweight the universal banks. Really, what we saw this quarter is that scale is winning. The consistency of these returns are sustainable, and they've got, frankly, a better mousetrap than most banks. The small cap banks that we talked about, these are the 50 to 100 billion in asset companies. These are companies with mid to high teens return on equity, and they're trading at 8 times earnings. And the reason why we like this group of banks is really the deregulatory narrative that's unfolding in front of us right now for the banks. These banks should be allowed to grow more freely and spend less money on non-revenue producing items. So there's a re-rating narrative in that mid-cap. And then in between, the large regionals, the fundamentals are great. But I think what our near-term caution is a little bit is they are acquirers. And so history says you have to be a little bit more careful when banks are consolidating.
All right, Chris, great to get some time with you ahead, of course, of Zion's results in about an hour's time. That is Christopher McGratty. He is Managing Director and Head of U.S. Bank Research over at KBW, which is a Stifel company. So certainly an interesting earnings week coming up.
Yeah, interesting words. We should point out that, we're still seeing these stocks below where they were prior to the sell-off that we had. What was that, on Wednesday or Thursday or whatever it was? But the idea that they seem to be bouncing back pretty fast in a way that we didn't necessarily see, what was it, a few years ago when SVB, and we saw the ripple effects of that, which obviously was more of a real bank run rather than just a footnote in an earnings statement.
Well, could be setting up for a reality check. We'll find out pretty soon, just about an hour. But coming up next on the close, I'm pleased to say David Kelly of JPMorgan Asset Management, as well as Stephen Parker, join us next to talk through their hot off the press report for long-term investing. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Katie Greifeld. JPMorgan out with a new report where they forecast 3 themes that will characterize investing over the coming decade. Those are economic nationalism, fiscal activism, and tech adoption and deployment. But it's that first one that sort of stopped me in my tracks, Romaine. Economic nationalism certainly is a word to describe what we've been seeing. Absolutely, not only here in the U.S., but obviously around the world as well. And it gets to the question as to whether that is actually investable. Yeah, a big question, certainly. So let's pose that to 2 of the people behind this report. Their names are David Kelly. He is Chief Global Strategist for JPMorgan Asset Management, as well as Stephen Parker, Co-Head of Global Investment Strategy for JPMorgan Private Bank. Great to see you both in person.
Glad to be here.
So, David, I'll start with you. Economic nationalism, is that just another way to describe deglobalization?
No, it's really about tariffs and immigration. So what we're seeing is a trade war. Obviously, we're sort of at the forefront of the trade war, but we are seeing these trade barriers go up. And to the extent the U.S. pushes up trade barriers, other countries will follow suit to some extent. And then also around the Western world, not just in the United States, but also in Europe, there's this pushback on immigration. And so it's like, well, we want to keep the goods out. We want to keep the more immigrants out. And that, those are kind of headwinds for the global economy. There are offsets, which we'll get to. But those are kind of headwinds because they tend to push up inflationary pressures and slow down economic growth. And so really it's trying to think about the other things that are going to allow us to move forward given those headwinds.
Well, Stephen, I'm going to steal Romaine's question because it's a good one. How do you invest around that? Because if you take the example of the equity market being sort of jostled back and forth by these trade headlines, it just seems to inevitably go higher.
Yeah, I think one of the things that we're trying to acknowledge, we need to realize in this report, is that there's perhaps never been a bigger gap between the stock market and the economy. There's a huge divergence, and what we're seeing in the stock market is that this shift to a more tech-heavy focus, the shift to companies that have asset-light balance sheets, that have more sustainable margins and less economic cyclicality, allows you to gain greater confidence in the ability to generate earnings growth. That's what's pushing markets higher, despite the fact that the pace of growth may be slowing.
Are you getting a good read, though, on the markets, if you are seeing that disconnect? Because we would always rely on the macro data to kind of divine where the stock market is going, and maybe vice versa as well. But I'm curious, with that gulf, does it change what you have to look at to try to figure out where things are going?
I think what it means is that you're going to see more divergence within markets. And parts of the market, like small cap, more consumer-oriented parts of the market, are going to have that cyclicality, more of that economic exposure. But the technology sector seems to be diverging more so from the economy. Now, that's more of a U.S. phenomenon. Globally, there's still an element of economic cyclicality in places like Europe, which is actually a good thing because we've actually upgraded our growth expectations for Europe.
Well, one thing, though, I am curious about, and David, this gets maybe to the idea of your immigration point, is this idea of sort of economic mobility. So with this sort of nationalism, we've seen it here in the U.S., obviously, shutting out immigrants, including high-skilled immigrants. You've seen other countries do it as well. And even on the tech front, we go back over the last few decades and you think about the sharing of ideas across borders. Is that lost, or is that just going to morph into something different?
I think it's partially lost. I mean, the United States has really grown because it's basically send me you're tired, you're hungry. Also send me you're skilled. Send me your goods. Send me your ideas. Send your. And we've been sort of send it all here. That's kind of been our attitude for 2 centuries, and now it's more like please keep it away, and that's not great. But there is also a counter reaction because the economy responds to that. So we will see a certain amount of development of our own industries, and all around the world, they are adapting to a world in which maybe the U.S. isn't going to be the only place for tech going forward. So it does, as Stephen was saying, it opens up opportunities. We're looking at places like Europe and emerging markets as somewhere where people are very underinvested right now in the U.S. and where U.S. investors are, and that's something to look at.
I do want to talk a little bit more directly about artificial intelligence because it's hard to talk about the coming decade without speaking explicitly about AI. You write that when it comes to the AI boom, it's going to be, of course, a factor there, but we're at a critical juncture, and I would love to articulate what that juncture is because that could mean different things to different people.
Well, yes, because we've seen so much enthusiasm, and it reminds me a little bit, of course, it reminds everybody a little bit of the late 1990s where we had the initial internet boom, and it was real. There's no doubt that the internet changed the world, but you still have to be careful around markets because we had a huge sell-off in technology stocks, and we had a small recession in the early 2000s. So we're worried that obviously we could get out above our skis in certain tech companies. I think you've got to be very careful which tech winners you're looking at. But also, this is long-term investing. And so we're thinking over the next 5, 10, 15 years, you're going to see AI more and more integrated. That is going to push up productivity growth. And we know that productivity gains tend to head towards companies. I mean, U.S. companies are very good at realizing profits from this. And this is really part of the sort of tortoise and hare we've got here. We've got a tortoise of an economy. We've got a hare of a market. And one of the reasons is that hare will gobble up the productivity improvements in the form of profits.
So, Stephen, are you seeing that already, at least with the publicly traded companies? Is there sort of a valuation that you can sort of put on that based on the potential for productivity improvements?
Yeah, so I think one of the things that we need to acknowledge is that, markets, particularly in the U.S., are expensive. And in fact, we forecast over the next 10 to 15 years something like a 20 to 25% decline in multiples. We still think that U.S. equities can generate close to 7% a year, which would mean doubling your money over that time period.
Yeah.
But I think what's important to recognize is that multiples, while they may come down, we don't think they come down to the long-term levels. The composition of the market today is better supported, stronger secular growth. And like we've been talking about, those margins are structurally higher, and AI is only going to support that.
I want to switch gears a little bit and talk about public versus privates, because in the alternative section of your report, you write that when it comes to private equity, the return assumption for private equity is about 10.2% right now. And you compare that to public equities, and it's pretty much on par. And we know that the last couple of years, interest in private markets has absolutely exploded. But when you compare the returns for public and private, and they're just about the same, I mean, does that favor one over the other?
We don't think it favors one over the other. We think it favors a complement of both. I think one of the important dynamics to acknowledge is the fact that capital markets have evolved and companies have the ability to stay private much longer. That means the pond from which private equity investors are fishing has gotten bigger and potentially higher quality. The comparison that we like to make is to look at private equity relative to public small cap companies, because traditionally when you were looking for those next big growth companies, the next winners, you would look to small cap. Our small cap expectations have actually been moderating relative to both large cap companies and private equity because those companies are not going public as small cap companies. So we're having more strategic conversations with clients who traditionally would have allocated to public markets to find those next big winners in places like AI to get exposure through private markets.
And one of our big themes here is that people, even if particularly if you've done no alternatives, get started, because bonds alone is not enough to diversify a portfolio. And we think that, if you're new to the alternative space, maybe having 10% of a portfolio in alternatives may make sense. And if you're more sophisticated or more, you've done it for a while, maybe 30% in alternatives could make sense. What we find is it can add to returns, but also lower the volatility of portfolios. And particularly when public markets have done so well, adding things like private equity, but also things like infrastructure, transportation, real estate to a portfolio just helps give it some balance at a time when frankly, markets aren't very balanced.
All right, well, we'll have to leave it there, but I encourage everyone really, if you can get access to this report, very illuminating, the 30th edition here of JPMorgan's long-term capital market assumptions. David Kelly is the Chief Global Strategist for JPMorgan Asset Management, and Stephen Parker there, Co-Head of Global Investment Strategy for JPMorgan Private Bank. All right, when we come back, we continue to count you down to the close with stocks approaching fresh record highs, and Apple, believe it or not, hitting its first record high of 2025. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. Time now for our stock of the hour, and taking a closer look at Apple, by far the biggest point contributor to the S&P today as it hits its first record high since December. Early sales data out from Counterpoint Research showing demand for the new iPhone 17 outpacing previous generations. Norah Mulinda joins us right now to talk a little bit more about this. So two things. A, kind of surprising that it's basically been, 10 months, 10 and a half months since Apple last had a record high. But also, what's sort of driving this sort of renewed optimism? Is it simply because people are looking at sales and saying they're not as bad as we thought they were going to be?
I mean, we definitely are seeing a 14% increase in comparison to what we saw from the previous series, the iPhone 16 here. So we are seeing.
Now, what model do you have?
What am I? I'm at the 14, embarrassingly so.
Gosh.
Double digits.
Don't judge me.
Okay. You're hurting the economy, by the way. But go ahead. Yeah.
Might be time to upgrade, honestly. But it seems as though a lot of people in the U.S. and China feel similarly. We're seeing a lot of people coming out in droves for this phone series in particular. Lots of optimism here, and apparently a lot of people going for the Pro Max. That's the larger one. I'm a fan of those.
The Pro Max?
Yes.
I don't even know what
you got to have the Pro Max.
It's true.
Is that the one that folds?
It's just a larger screen.
That's like the iPhone 24. But let's talk a little bit about some of the narratives that have been haunting Apple, which it looks like they're getting away from a little bit, putting some distance in between them and the idea that they were falling behind on AI.
Absolutely. I mean, that's been a discussion for Apple in particular in comparison to a lot of the Mag 7 counterparts. I mean, everyone's really focused on the AI push, and it seems as though that's what the street is really looking for right now out of Apple. But I mean, on the mind of investors continues to be the tariff conversation, of course. If you think about trade relations as well, just between the U.S. and China, also rare earth materials, it's something that not only is in conversation about Apple, but a lot of the other companies that are going to be reporting this week. So a lot that this company has really been grappling with. But shares are up about 5% year to date.
But you say they've been grappling with it, but I mean, at least for the last couple of earnings reports, they've shown they can navigate it. And we know that Tim Cook, I think he just lives at the White House at this point right now.
He must.
Right, in that new Rose Garden. But it gets to this idea, though, as to why would investors be skittish at this point? I mean, we already know how big the Apple ecosystem is. And while growth may not be what it was, I mean, why would it be with a company this size? But what else are people going to buy? Like if they're not buying the iPhone, I mean, I understand you have this whole university of Android users, but that's also that growth there isn't really any better than what we're seeing with iOS phones.
Right. I mean, I think that expectations always continue to be super high with Apple. I mean, they're pretty much the hallmark phone. It's either do you have an iPhone or what? You have an Android? That's pretty much what the conversation has been like colloquially. But I would say that that's really is what the pressure is here for Apple is just what can they do next? People are always looking for what the new thing is going to be coming out of the company.
I've been thinking about downgrading my phone, Katie Griffin.
Ooh.
Go on.
Just to like, you know, like something a little more simple.
Like a flip phone.
Yeah, like
maybe
a flip.
Blackberry.
Oh, that would be nice.
Yeah,
I love just go all the way back to a pager.
Yeah.
Remember Pactel?
The good times.
It'd be hard to keep in touch about the show, but that'd be fun too.
That's the point.
Norah, great reporting as always. Welcome back. That is Bloomberg's Norah Mulinda. Apple getting a little bit of its mojo back. So too is the broader equity market. We're about 15 minutes away from the closing bell. We'll take you there with Tony DeSpirito. He is Global CIO of Fundamental Equities over at Blackrock. That conversation coming up next. This is The Close on Bloomberg.
I think our main point I'd say up front is we still think this bull market deserves the benefit of the doubt. There's always potential cracks. We had some concerns last week around the credit side. There were some concerns about sentiment. But in a bull market, you climb this wall of worry, and that's what we're seeing it again.
Keith Lerner over at Truist kick us off to the close just about 50 minutes ago. Stocks, when we started the show, were near session highs, and stocks right now, Katie Greifeld, near session highs.
Absolutely ripping right now on the S&P 500, higher by more than 1%, nearly 1.2%. We're looking at the best two-day advance for the S&P 500 since June, and it's big tech that's leading the way. The Nasdaq 100 higher by about 1.4%. Can't really explain the bid into the bond market. It's not huge, but we are below 4%.
Below 4% there. I mean, and we should point out a very modest bid here on the day. But it also gets to this idea, too. We're still in the middle of a shutdown. There's still a lot of risk out there. So it kind of makes some degree of sense that you are still seeing some bids come into some of those other asset classes.
Right. Well, that's the bond market. In the equity market, it seems like full steam ahead because the VIX, too, dropping like a stone right now, looking at 18. We were well above 20 last week.
Absolutely. Here, as we move closer to those closing bells, let's bring Tony DeSpirito into the conversation, Global CIO of Fundamental Equities at Blackrock. And Tony, there's been a lot of people looking at this bull market. I think we've now kind of officially entered the third year of this, at least if you go off the bear market lows in 2022. And everyone's kind of trying to figure out, I guess, A, why we're not seeing more conviction to the upside, but more importantly, why there doesn't really seem to be anything that can knock this bull market off of its pivot.
Yeah. So look, I think we're kind of in a K-shaped economy and a K-shaped market. AI on the upside. The economy is definitely soft, particularly at the low end for like the low end consumer. And so you're seeing softness there. Like even toothpaste sales are a little weak, right? People are squeezing more out of the tube. And so we really see that divergence. And I think that really explains what we're seeing.
This gets to an idea, too. I mean, we were just speaking with Stephen Parker over at JPMorgan Private Bank about their latest outlook. And he talked a lot about sort of the gaps between what we're seeing in the economy and what we're seeing in the markets. And we've heard this from a lot of folks here that gap has widened. I mean, there's always been a gap, but it's widened. And I'm curious if that worries you at all from the perspective of being able to divine what sort of moves the market in either direction.
Well, I mean, as you point out, it's pretty typical, actually, that the economy and the market don't move together, right? And so with a softer economy, and it's not weak, but softer economy, we're seeing lower rates, right? The 10-year Treasury, the yield has fallen from about 4.6% at the beginning of the year to about 4% now. Well, that's positive, right? That gives a boost to valuations. So I think we're seeing that. We're also seeing really strong earnings. If you look at earnings estimates last quarter, earnings were up 11% year over year. That's nothing to sneeze at, right? That should be driving the market stronger. Of course, expectations for third quarter aren't that bullish, but I think the bar is pretty low. I think we're going to beat earnings pretty nicely, and we'll probably end up with 10%, 11% earnings growth once again. So I think those are the things that are really driving the market.
And I guess when it comes to earnings, as you said, the expectations look pretty good right now. Things have been pretty solid. But how broad-based are we talking about? Because, I mean, it feels like you dissect anything, peel back enough layers, and it just looks like tech is driving everything. And is that expected to be the case in this coming earnings cycle as well?
So obviously tech is a big opportunity. AI is a big deal. There's big change there. That's a big wave, and it's driving the mega cap end of the market. But that doesn't mean there aren't opportunities beyond that. I see opportunities in healthcare. I see opportunities in financials. I see opportunities in the housing market. So I'm seeing a really broad base of opportunities beyond, the Mag 7.
I do want to talk about tech a little bit more, even though
Sure.
there are all those opportunities, because the conversation we've been having over the past week, 2 weeks, is how you're starting to see the relationship between some of these big tech companies and how they treat the debt market change. You take a look at the investment grade debt market, there's more debt tied to AI than there is to financials, which is pretty stunning and certainly a sign of the times. And I wonder, as we see ambitions expand at some of these tech companies and we start to see them tap the debt markets to fund that, does that change the nature of investing in some of these tech names?
Well, I'm a big fan in playing it reasonably safe, I'll call it. And one of the things that I think there are a lot of things that distinguish what's going on now versus the tech bubble that we had in 2000, right? First of all, remember the tech bubble in 2000, the NASDAQ was up 90% plus 2 years in a row.
Wow.
The valuations were off the charts. I can tell you a whole list of companies that were trading at over 100 times earnings, whether it was Cisco, Qualcomm, Nortel, EMC, Sun, et cetera, right? That's not what we have today, particularly with the mega cap AI companies. They're trading at 20, 25, 30 times next 12 months earnings. That's very modest compared to what we saw at the tech bubble. Plus, at the tech bubble, at the end of it, you had the Fed tightening. Now we have the Fed loosening. So I think we're in a very different place. But I much prefer, and one of the things I like about the situation right now is the companies have free cash flow, right? The big spenders, for the most part, are spending out of free cash flow. They're not borrowing money. And so I think it's prudent to stick with the companies that are funding their AI investments through cash flow as opposed to having big borrowing commitments. Because in that, I see risk. There's plenty of upside through AI. Play it the safe way.
Any worry, though, about some of that investment and the lack of return on it?
Yeah, that's been it's certainly an issue. It's certainly something we have to watch. But increasingly, we're hearing companies starting to go from R&D stage with AI to implementation. I think we had Jamie Dimon last week speaking about how the cost savings roughly equal the investment that he's making in AI. That's a powerful statement. A 1-year return, that 1-year payback, that's tremendous, right? And so I think we're going to increasingly see that kind of rhetoric coming out of companies. And so I think the returns are coming.
Yeah.
But it's something we have to watch. I agree.
I'm just curious real quick. We only have about a minute left. But I'm curious just about the IPO pipeline and just the opening of public markets to this horde of private companies with large valuations and in some cases relatively good fundamentals. Do you think we are going to see a real march in the public markets from some of these private companies?
Oh, I think the capital markets are going to be. We saw from reported earnings they're quite strong. We knew that. I think that'll continue to be strong. There are a lot of companies waiting to tap the public markets. Some of them will be very attractive, some not so attractive, right? And that's the job of us as investors, is to sort through that. But without a doubt, a lot of companies are going to be coming public.
All right, Tony, always great to have you.
Thank you.
Tony DeSpirito, Global CIO of Fundamental Equities over at Blackrock, counting us down to the closing bells. Katie Greifeld with just about 3 minutes to go here. Stocks near session highs. But again, this is a pretty broad-based rally today. Yeah. Tech, of course, is out front, led largely by that big upswing in Apple on the day, but you've seen a lot of other folks participate as well.
Absolutely. You take a look at the breakdown of the S&P 500, more than 400 names in the green right now. So to your point, a lot of participation, even though you do have volume a touch lower right now, but we're really getting into the exciting stuff in the next coming days.
Absolutely. A lot of earnings coming out this week, a lot of big potential geopolitical issues as well that could be sorted out. A full breakdown of all of today's market action and a push ahead to what comes next. That starts now with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with the global simulcast. We're joined right now by Carol Masser in the radio booth, Tim Stenovic by her side. Welcome to our audiences across all of our Bloomberg platforms here on this Monday afternoon with stocks right now near session highs.
I just want to know where all of you guys were this weekend, because as Tim pointed out, he wanted to know where I was this weekend. I was not in Paris. Were any of you in Paris?
No.
Because of the big heist?
I mean, I don't know where Romaine was, but I certainly wasn't.
Can you imagine?
Yes.
one of these two showing up wearing the jewels?
God, there was a gorgeous emerald necklace, right, that was stolen?
Can you imagine?
The story's amazing.
It is. It's crazy. 7 minutes. You can do anything in that amount of time.
All right, but speaking of markets, I'll go back there, but I think it's an amazing story. Romaine hasn't said anything, so I'm a little suspicious. Anyway, I was thinking of you, Romaine.
The first rule of Jewel Heist Club is don't talk about the Jewel Heist Club.
Small caps, outperformance. I mean, the whole market's up, but small caps are up almost 2% in today's.
Okay, that's today's trade. What happens when we hear from all these companies? We're going to hear from a lot of car companies this week. We'll hear from General Motors and Ford. We'll hear from Texas Instruments. We'll, of course, get Netflix, an update from Netflix. So does the tone change after today?
How about Zions in just a couple
That's going to happen very soon.
I'm very excited for that and to hear, of course, what the C-suite has to say.
We should point out that earnings expectations pretty much across the board have actually crept up over the last few weeks. In fact, when you look at some of the earnings revisions to the upside, some would say this is actually probably one of the strongest upcycle revisions that we've had in several years. So the bar being raised just a little bit here. So it'll be interesting to see whether the companies can actually meet that bar. So far, the beats that we've seen in this relatively short earnings season have certainly been encouraging. You're taking a look there at a NASDAQ composite up more than 300 points on the day. I believe that is going to be enough potentially for a record high. Let me just double check that. Up 300 points or about 1.4% on the day. The S&P up 71 points or 1% on the day, while the Dow Jones Industrial Average adding more than 500 points or 1.1%. And the Russell 2000 not just getting in on the action, but actually leading it. 48-point upswing for the Russell 2000, up 1.9%.
Yeah, some nice outperformance. Back to the big caps I go. And folks, this rally today, pretty broad-based. Katie, we got 414 names in the S&P 500 higher in today's session, 85 to the downside, 4 unchanged.
Well, the circle broadly says the same thing when you take a look at the sectors. 9 finishing in the green, just 2 in the red. Communication services, materials, industrials, those are some of your biggest winners today. Then you take a look at what didn't do too hot, consumer staples, utilities. Those are typically defensive sectors. So to see them down just a little bit here really speaks to just how risk on this Monday was.
All right, guys, with all that green, lots to choose from.
And I just want to point out, sorry, too, just to be clear here, the NASDAQ 100 did close at a record high, but not the composite.
Okay, good to know. Good to know. Hey, having said that, a good reason why we saw that composite moving up on this Monday. Apple shares finishing off their highs of this session, but still with a gain of just shy of 4%, hitting their first record of 2025 after Loop Capital upgraded the stock to buy from hold, becoming the latest firm to cite positive iPhone demands. We did have reporting out on the terminal about Apple's latest generation of iPhones. We're talking about the iPhone 17 series, off to a faster start than usual with its most basic model surging in popularity. So, man, that was certainly a lot of momentum in today's trade. Got to mention Cleveland Cliffs. That stock up just about 21.5% today after the company posted stronger than expected earnings and disclosed a pact with another metal producer. The company said it discovered 2 sites with potential to produce rare earth minerals, one in Michigan, another in Minnesota, and is evaluating whether rare earth minerals can be extracted from those mines. So, again, that trade, that play, we continue to see that having momentum here in 2025. Got to mention Zions. We are waiting that company to report earnings, that regional bank. Stock up 4.6% in today's session, higher after a wild week last week on concerns about credit. The stock, as we mentioned, higher today. 2-day gain of about 9% in today's session after dropping 5% last week, but we'll wait for an update on its business as it gets ready to report in any moment. And just honorable mention, those rare earth and critical mineral stocks on the move, U.S. Antimony among them. This after William Blair came out and talked about these companies, initiating the companies at an outperform. I just had to mention, because we talked to U.S. Antimony today, the CEO. That stock was up 19% in today's session.
That is a big move higher, especially for that company that's, what, is it more than doubled so far this year?
Yeah, like 400%. Isn't it like 500%?
It's pretty incredible. Hey, some of the stocks in the red, not too many, but a couple prominent ones. I want to start with Oracle, down 4.9%. Shares fell for a second day in a row. They fell close to 7% on Friday, down another close to 5% today. Still up, though, more than 66% so far this year. No real catalyst for this move, but again, still up more than 66% so far this year, and among the worst performers in the S&P 500 today. The worst performer in the S&P 500, though, was AppLovin, down 5.6%. Shares fell after the New York Post reported that state regulators have reached out to multiple short sellers in a possible preliminary probe for the mobile advertising company. The states include Delaware, Oregon, and Connecticut. The report comes after news earlier this month that the SEC has been probing AppLovin's data collection practices. And finally, ADRs of BNP Paribas closed down 9% today. A jury found that BNP Paribas was liable for its role in enabling genocide in Sudan, awarding about $21 million to 3 plaintiffs. That verdict triggering speculation that the firm will have to agree to expensive settlements, with one analyst estimating a possible settlement of as much as $10 billion. Shares in France fell close to 8%. The verdict, though, is, quote, specific to these 3 plaintiffs, and any attempt to extrapolate is necessarily wrong, as any speculation regarding a potential settlement is, the bank in part said in a statement.
All right, let's take a quick look at yields. We did actually see prices across the board higher, with most of the activity on the longer end of the curve. That pushed your 30-year yield down by about 3 to 4 basis points. Similar move today for the 20-year. Your 10-year yield now at 3.98, down about 3 basis points, guys, from where it was on Friday.
All right, good stuff. As we await Zions Bancorp earnings to cross the Bloomberg terminal, a couple stories on our radar. One that caught our attention. This has to do with women-focused resorts are becoming kind of the next big wellness trend. We've talked about it a lot here on our air about the lack of R&D and attention spent to women's health. Well, Canyon Ranch is getting ready to unveil its 3rd location, and basically they're going to focus big time on women's wellness, Tim.
Yeah, this is a 600-acre ranch. It's close to Austin, Texas. The wellness industry, though, has historically underserved women. Only 5% of global R&D funding allocated to women's health research back in 2020. But now these companies are really seeing an opportunity for that, and they're coming out with these targeted retreats focusing on women and focusing on attracting women to these places.
I love Canyons Ranch. I went there with my mom and my aunt when I was like a preteen, which was a weird vacation.
Which one did you go to?
We went to the one on the East Coast. I feel like it's like upstate somewhere.
Berkshires, like outside the Berkshires?
That sounds about right. It was great. That's all I have to add.
Well, I think the majority of people who go to them are women already.
Yeah.
So they're just trying to broaden their appeal, or not even broaden their appeal, but focus on that demographic.
And dig deeper, I feel like, into kind of serious health issues for women as they get older and so on, or different stages of their life.
Well, speaking of wellness, another story that I was keeping an eye on was kind of the waning interest that we've seen in a lot of sort of wellness products, particularly in the food space, particularly when it comes to these alternative milks, if you will. Remember, it was all the rage. You get your nut milk, your oat milk, and all these things. Well, CEO of Oatly gave an interview to the Financial Times and talked a lot about just the drop that he's seen in demand, and said a lot of this he's blaming, at least, on the lack of discussion about climate change and other things that I guess helped to sort of create this industry in the first place.
I thought that, I mean, at least when it came to almond milk, they got a lot of bad press for just how water intensive almonds were. Oat, maybe a different story there, but I don't know, it does just feel like one of those fads that we've put behind us. But if you're the CEO of one of these companies that soared so much when this was in the zeitgeist, I could see it definitely being in the hurt locker right now.
On record? Sorry.
There we go.
So people are fed up with climate talk? Is that it? And so there's a pushback?
Well, I think the idea is that we're not putting as much. The idea is we're not putting as much focus on it, like the royal we, and that means that I guess one of the main selling points of a lot of this, obviously, it wasn't just nutrition, but it was the idea that somehow what we were drinking was better for the environment. Whether that was true or not, who knows? But that was the argument.
Just anecdotally speaking, I mean, I kind of tried all this stuff back in early 2020s.
Yeah.
The Beyond Meats and the
me too.
Impossible.
Yeah.
But I think a lot of people were like, wait a second, this is kind of moving away from single ingredient things, right? And it's processed in a way that they don't necessarily want.
Well, that was a big thing for me, Tim. I mean, it was like, as you started to look at the ingredients and some of this stuff, you're like, well, how is this actually better for me than just, I don't know, eating a salad or something, like you said, a little bit purer. So, it's a trade-off.
I will say the one thing I appreciate about these milks is that, at least as far as I understand, you don't have to refrigerate them. So that was cool. But
don't take that advice, right?
Yeah, you don't have to refrigerate a cow either. They just live outside, Katie.
True, but you should refrigerate cow milk. I don't know. I don't
This is
drink a
why
lot
we
of
should
milk,
just
so.
drink tequila, okay? Let's just put it out there. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, not for breakfast, though. I'm just going to point that out. All right, Katie and Romaine continuing there on the close on Bloomberg TV. Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
As we await those earnings coming out of Zions, we keep a focus on the broader economy as well. That discussion coming up next, particularly with Federal Reserve policy in the crosshairs. Isabelle, Mateos, Lago is going to be joining us, BNP Paribas Group Chief Economist, after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A record day on Wall Street, at least for one major indice. The NASDAQ 100 closing out the day at a record high. The S&P and the other major indices came pretty close as well. You also see a strong bid coming into the Philadelphia Semiconductor Index on this day. A drop in the VIX. And take a look at the KBW Regional Banking Index, Katie. A rebound coming off of last week's losses, up about 2% as we await those earnings today out of Zions.
Well, let's take a quick look through what some of the big movers in the equity market were today. Apple, of course, closing at a record high. That was a big one, up about 4% on the day. Nvidia down slightly, off by about 0.3%. I highlight that because even with this slight decline in Nvidia records for the NASDAQ 100, as Romaine says, and Beyond Meat, this was an interesting one, down 60% year to date still, even with this huge pop that we saw today. But
127%?
127%
What?
seems like it has caught the eye of maybe some retail traders there. But let's get to our top story this hour, and that is earnings season well underway, with about 85% of the companies in the S&P 500 reporting results having beaten profit expectations. Now, this is the last of the regional banks start to trickle in, including Zions, which just last week said it will record a $60 million provision and a charge-off of $50 million, fueling concern, Romaine, that there are more cracks emerging in the credit markets.
Well, Herman Chan over at Bloomberg Intelligence follows this better than anybody. He joins us here in Studio 2. Herman, I know you haven't had a long chance to sort of look through these numbers here, but as expected, we did see charge-offs come in above estimates, $56 million in the third quarter. Net interest margin looks like a beat. And then I thought this was interesting. The provision for credit losses, $49 million. The street was looking for 26.4. Right. Are these numbers relatively in line with what you were thinking of?
They were. I think the estimates were a bit stale. That didn't incorporate last week's pre-announcement on the charge. That being said, it looks like credit quality was pretty good outside of this one issue. So they talked about net charge-offs being about 4 basis points outside of the $50 million. So no issues from credit outside of the one charge related to those cancer loans.
And you see the reaction after hours right now. Zion's up about 2%. It had been rebounding into this print, maybe suggesting that investors were a little bit quick to sell off this name on that news. But talk to us a little bit about what you're expecting from the call and what tone you think management needs to take here. The numbers look pretty good, maybe worse than or better than feared here, but still, what messaging do they need to execute?
I think the messaging will be about reinsuring the market, especially with credit quality, how they select their clients, how they monitor their credits. I think that's one of the questions going in, is that they had this issue and they only found out about it after Western Alliance sued the borrower. So just credit monitoring in general, I think, is what the analyst community will dive into on the call today.
But that gets to a broader point as to sort of what exactly that due diligence has been or maybe not been, and not just to pick on Zions, but there are broader questions being raised here about whether we did see sort of a drop in, I guess, people dropping their guard more or less in pursuing some of these loans and these deals.
Yeah, I think so. I think that's probably the common thread through some of these issues with Tricolor, First Brands, and now this issue with Zions and Western Alliance, is that really client selection and how you deal with your customers, and are you creating an incentive by just being very lax on your underwriting? So that's something that seems to be pervasive.
Are you worried about that? And the reason why I ask is, I mean, we've already heard, based on Bloomberg reporting, that there were a couple of folks in the private capital space that apparently saw this and got out. Of course, Oaktree was probably one of the more notable ones that we've reported on, a couple others. So I guess my question is, why can their research suss out a problem and bail out, but not necessarily the banks?
Yeah, I think that's a very good question, and I think that's one that the market's trying to grapple with now, is like where we're seeing from a lot of the industry data from the Federal Reserve, from the SLOOS data, that underwriting hasn't really been that lax, so we're not seeing that degradation, but we are seeing these one-offs, so that raises a lot of questions for the industry.
And Herman, just quickly here, speaking of the industry, it's not just Zions we've been keeping an eye on, it's Western Alliance as well. Shares moving a little bit higher after we parse through these Zions results. Is there anything we can extrapolate out from Zions that might portend what we could hear from Western Alliance?
Yeah, so for Western Alliance in particular, they haven't really said they would take a charge off or a provision related to both of their exposures to this Cantor loan and also to derivative exposure to First Brand. So we're actually expecting some fairly benign credit despite the sour mood in the market on the Western Alliance stock.
All right, Herman Chan of Bloomberg Intelligence parsing through those Zions resorts. Zion shares up about 2.5% after the bell. Really looking forward, though, to the call, Romaine. As Herman says, a lot of focus will be on how they're selecting and sort of doing due diligence on their clients.
I think they have to address that, not just them, but a couple of other banks as well when they report, when we hear from them as well. I mean, because this is very clearly something that was telegraphed. It's just a matter of question of why it wasn't acted on.
Absolutely. So we'll continue to follow that. And coming up next on the close, investors and the Fed all flying blind into Friday's CPI print. BNP Paribas chief economist Isabelle Mateos Lago. She joins us next to cut through the noise. This is the close on Bloomberg.
All right, here in the U.S., we're counting down to Friday's CPI print, a delayed CPI print. One of the few data points cutting through the fog of the government shutdown. Estimates show a slight uptick year over year and a steady monthly figure, likely enough to keep the Fed on track, maybe for an October rate cut. Beyond that, analysts say it's a murkier picture, especially if inflation surprises to the upside. Isabelle Mateos Lago joins us right now, chief economist over at BNP Paribas, to talk a little bit more about this. And we should just point out, Isabelle, I mean, we're talking about inflation in this country, at least, that has been above the Fed's 2% target now for, I don't know, something like 3 years, at least when you go by core PCE. Do you see any sort of meaningful potential for that to actually come down to that 2% target anytime soon?
Yes, so good afternoon. Thank you for having me. I think the question here is, yes, it will come back down to its target. That's what markets believe. That's why inflation expectations have not lifted in line with inflation itself. But anytime soon, probably not. And in fact, in the near term, from my standpoint, the only way to go is up, and that's because the pass-through from tariffs has mostly not happened, and there's still a lot of that to come through. So actually, we see inflation continuing to accelerate over the next 6 months and peaking around 3.8%, and then it will, assuming the Fed runs the right monetary policy, which there's every reason to expect it will, then inflation will start declining, but near term, it will go up.
Do you think that monetary policy here in the U.S., or at least where everyone thinks it's going, which is further easing, is in conflict with what we're seeing on the fiscal side?
So the question in front of the Fed is the Fed has a dual mandate. And so inflation is one side of the mandate. If it had a single mandate, it probably wouldn't even think of easing, but it also has a full employment mandate. And on that ground, there are reasons to be more cautious and even to think maybe we shouldn't be running restrictive monetary policy at all. So it is a balancing act. And that's why I think they're going to proceed very cautiously. And frankly, that's what we heard from FOMC members who were around town in D.C. last week and on your set. I think all of them really emphasized the need to keep the balance on both sides of the mandate. And given that there is an upswing in inflation, they have to be really careful that there are no second round effects.
It's interesting that, you know, listening to the FOMC members speak, okay, maybe the consensus is we're going to proceed cautiously, but someone was making the point to me this morning that for the first time in what feels like a long time, you have really overt hawkishness and dovishness on either side of the debate. I mean, in the pandemic, it really felt like the FOMC was marching as one. Sort of the public facing speeches that they would give sort of came from the same choir, but now it just feels like you have a lot of dispersion when it comes to views.
So I think there's definitely at least one Fed governor who's been outspoken in saying he thinks there should be a front loading of rate cuts at this point in the cycle. I didn't hear him say that he doesn't care about inflation. It's just he thinks that given the circumstances, that would be the appropriate thing to do. All the others, I would say, have been very cautious, in fact, in emphasizing the risks to both sides of the mandate. And they may have a slightly different appreciation of how many rate cuts that translates into over the next 3 months or over the next 6 months. But actually, I find that in terms of their focus on managing both sides of the mandate, there isn't that much gap between the other members of the FOMC.
Fair point. And of course, we've spoken about the inflation side of the mandate. Let's talk a little bit in more detail about the labor side of things, because we've definitely seen indications that this labor market is weakening, even without the helpful tool that is U.S. official government data here. And I wonder, when it comes to threading that needle, it seems like a very difficult job to do. How worried are you about the labor market side of things?
Not very. If I had to summarize, the labor market has been, I would say, moderating more than weakening. But as you well know, the unemployment rate remains very close to historical lows. Now, some FOMC members will say, well, you can't rely single-mindedly on the unemployment rate, and that's right. But the quits rates, the vacancy to unemployment rate, all these variables are sort of in line with their long-term average. So I don't think it is a weak labor market, but it is a labor market that, if the economy were to be hit by a shock, then you would see a rapid deterioration. And clearly the Fed does not want to take the risk of that rapid deterioration. So that's why, on balance, they want to play it safe and ease a little bit. And the issue is you have to look at the overall economy. When you look at the Atlanta Fed GDP nowcast, you have an economy that's running at 3.8%. That is not screaming for a rate cut. On the other hand, consumption, you mentioned earlier the K-shaped economy. There is clearly a part of the population that is cutting on consumption because it can't afford to consume more. So that's a warning sign. When you look at business investment, again, the picture is very lopsided. You have essentially all of the investment that is happening is in AI and software, and the sort of normal business cycle investment completely flat, and then residential and structures falling. So again, this is the sign of an economy that has areas of great dynamism, but other areas that are weaker. And so I think it makes sense in that context for the Fed to be careful, and I think that's what they're doing.
I am curious, too, about the disparity that we're about to see between what the Fed's about to do and what other central banks aren't going to do or maybe have already done. Obviously, the ECB has already kind of, patted itself on the back and said, we're done. Then you have other countries like the U.S., Brazil, and a few others that are saying we're about to start cutting rates. Does that matter, that lack of synchronization in global monetary policy?
So the most important thing is that each central bank runs monetary policy that is appropriate for their circumstances, because if they don't, you have bigger problems. But then, of course, if you have a desynchronization, almost certainly you're going to see an impact on things like exchange rates. So now you're going to have an ECB that, very likely is done cutting, maybe does one more cut, but very doubtful more, and you're going to have a Fed that is going to do probably multiple cuts. Could it impact the dollar negatively? Yeah, probably. Mm-hmm. But that's not something to worry about.
Before we let you go, we have just about a minute left. As we look into 2026, obviously one of the most urgent questions is Fed independence. And I wonder, as you look into the next year, whether or not that's something that concerns you as well.
Yeah, so it's interesting that you make this a 2026 issue, because de facto, thanks to the timing that has been announced by the Supreme Court, nothing's going to happen until then, which is frankly very helpful, because not that people have stopped worrying about it, but there's more time to think through the implications of one scenario or another. But so yes, that issue is going to be very important. And what I want to stress is, everybody's calling it the issue of central bank independence. Independence is frankly, I don't think, the question, really.
Right.
Yeah. The question is the credibility.
Right.
So far, there's no reason to doubt the Fed's credibility, but that needs to be preserved, and they're going to be under heightened
Isabelle,
scrutiny.
Up against the clock, great conversation. Have to have you back. That is Isabelle Mateos Lago, Chief Economist at BNP Paribas. Well, confidence among U.S. home builders rising this month by the most since early 2024, boosted by lower mortgage rates. Our next guest says that those rates are hovering near a one-year low, providing some relief for buyers. I'm pleased to say that guest joins us now. Ryan Serhant, he is the founder and CEO of Serhant. Great to have you on set with us.
Thanks for having me.
So some relief for buyers. Is that enough to say this is a buyer's market? Are we on the way there?
No one wants a lot of relief because they don't want what comes with lots of relief. Every time you get a lot of relief, it comes because something terrible is happening and everyone goes on their heels anyway. We should have another Fed rate cut, roughly, right, in about a week or so. That'll slowly put pressure on mortgage prices. Although I don't know, because we have a government shutdown right now, so no one knows what's happening. Unemployment, we don't know. And we just keep moving forward. But your 30 years in the low 60s, ARMs are in the high 4s, you know? Like that's a moving market, so that's what we're seeing.
Well, let's talk about that continued pressure on mortgage rates, because if we do get meaningfully lower, where things actually start to feel a little bit cheaper, I mean, how many buyers are just lined up on the other side of those lower rates, ready to jump in?
About 4 million.
Yeah.
Yeah, like if you look at historically where we were in probably the healthiest real estate market we've known in the last 25 years, we should have at least 6 million, if not more, home sales nationally every year. We're hovering now at around 4, and that's where we've been for the last 3 years in a row. And you're starting to see some of that weakness. September, I think, had the longest days on market for a home in the United States, about 50. In 10 years. Pricing continuously creeps up. So we need pricing to come down a little bit so there's more affordability. We need affordability to track with income, which just hasn't happened in quite some time. So there's a lot of things that have to come together so that the housing market could open back up. But if you're in the market, you can get a deal right now.
If we do see that market open back up, is that going to be across the nation, or is it going to be confined to certain geographical regions?
No, it'll be across the nation. The luxury market is always there, right? It has its peaks and valleys, but people are always excited to buy luxury because they look at it as an alternative to other types of investments, right? Like gold. Gold is up, what, 66% this year? Those buyers are also putting dollars into real estate. What we really want is for the average American to be able to balance the monthly costs from a rental to a home. And right now, it is cheaper to rent in most markets than it is to buy, where in a lot of markets, the starter price is still over $1 million.
Just on that last point, though, about luxury buyers and particularly the idea of using real estate as an investment, are you seeing more competition, particularly in that space? And I mean, like the idea that real estate was kind of that tried and true real asset, if you would, that diversified your portfolio. But there's so many other alternative assets out there right now. Are you seeing any meaningful competition for real estate as an investment?
Oh, yeah. I had brown hair this morning.
Yeah.
I mean, between all of our prime markets, New York City, Palm Beach, Miami, the West Coast, I mean, you know, we have our TV show on Netflix, Owning Manhattan. The second season comes out December 5th. There's a deal on that show, which is a bidding war for a $60 million property in the west side of New York for a resale. Those buyers want what they want. We just put a $75 million property in Palm Beach into contract, and it was a bidding war between 2 separate purchasers. But yet across the street, for a home that's worth maybe 10x less, it's taking time to find movement. So at the top end of the market, there's very, very little inventory, and buyers are pushing.
Well, that's certainly a stratosphere that very few can relate to. So let me bring it to something a little bit more tangible. I am looking in Hoboken right now, for example. Nearly every place is turning into...
Every day. This is all she talks about.
Romaine hears about it all the time. Every place, every property pretty much goes into a bidding war. Everyone's a cash buyer. And I think some of the pressure that people feel is that we're heading into a seasonally slow period. We're heading into the holidays. And you fall into this game when you're going to all these open houses, which is all I do, is that how do I know that I'm not going to see something better listed come back in January, come back in February? And I wonder, you know, when it comes to some of these really hot markets, what that equation looks like.
How long does it take you to order dinner?
About 10 minutes.
That's a long time.
Yeah,
it's a long time. Listen, you can always wait for something better, in which case you're just going to stay in the current home you're in and you're not going to be able to enjoy life. At some point, you have to give, and no one can ever perfectly time the market. If you see something you like, you really like it, and you make an offer that you think is a good deal, where if you get it, you won't have buyer's remorse, but if you lose it, you won't feel bad either, because you'll say, so glad they got it, then move forward. Like, life is short. A long time ago, an asteroid came out of the sky and killed all the dinosaurs, and they don't get to have houses in Hoboken either.
That's true.
So onward and forward.
On that point, though, and since we're sharing anecdotes about our housing
where do you want to buy? I'll help you.
Well, that ship has sailed. But it gets to this idea of the sellers. So a lot of them are sort of locked in because They bought at much
Yes.
lower rates.
Yep.
They're trying to sell at prices that are elevated, and we ran into this issue. And I had one seller, we had a long back and forth, like several weeks back and forth. Would not budge. He tried to offer some concessions here and there, but ultimately the price was the price. And ultimately what he told us, me and my wife, was basically like, look, he's like, I'm basically breaking even on this at that price. And if I take what you're offering, I'm losing money. And I do wonder where that balance is right now across the board.
Yeah, we have that conversation with everyone, even in the luxury market.
Yeah.
If you bought at the top of the market, right, either somewhere between 2013 and 2016, or in a suburban market somewhere between 2020 and 2022, there is a chance right now that you might break even or take a loss. But it's not all about the singular asset. The conversation we have with sellers all the time is think about your life as an entire movement. You take a little bit of a loss here, but it's okay. Let's look at your portfolio. How much has it risen over the past 4 years? You're thinking about one little loss here when you've gained wealth over here. You have to think about the entire package of your life. And what we tell sellers too is you might think you're selling at a discount to today, but if the market goes the opposite way, which I don't think it will, but if it does, the offer you have on the table today is a premium to what you could get 6 months from now. So you can roll the dice if you want to, or let's move on. Like, again, you know, people sit and they count pennies. You don't want to cut your nose to spite your face.
All right, well, that's good advice. You should get your own show.
Yeah, Owning Manhattan Season 2 is the greatest TV show in the history of the world.
Ryan Serhant, founder and CEO of Serhant, and as he just said, the star of Netflix's Owning Manhattan. All right, well, speaking of Netflix, how's that for a segue? The streaming giant is scheduled to report earnings tomorrow after the bell. Full coverage right here on The Close, but right now we give you a preview with Chris Palmeri, our man out in Los Angeles. And Chris, I don't know if you're a big Ryan Serhant fan. You have to say you are because he's sitting right next to me still. But let's talk about Netflix's results, or what we expect, particularly in light of what we heard the last 2 quarters, which surprised to the upside.
Yeah, this is the market's looking at double-digit gains in revenue, profits. I mean, the stock's already up almost 40% this year, so everyone's anticipating a real strong quarter for good reason. You know, they've had a lot of really popular shows, K-pop Demon Hunters, the last Squid Game, of course, Owning Manhattan. And so, you know, this is just could be another killer quarter for them.
Yeah, and it's interesting. I mean, just the moat that Netflix has built around itself. You mentioned, you know, some of their big hits here. When it comes to Netflix versus the rest of the competition, what does the competitive landscape currently look like?
Well, you know, one of the issues is, you know, they're not reporting new subscriber numbers anymore, just kind of the standard metrics of revenue and profit in that. But there are firms that estimate them. And for example, Antenna, one of those firms, just came out with numbers today. Continued strong results. I mean, one of the most notable things about Netflix is something called the churn rate, basically how many customers cancel every month. It's just 2% at Netflix versus 10% for some of the other streaming services. So you're just seeing, you know, they're really just sort of like the TV utility that nobody bothers to come in and out of.
All right, Chris Palmeri out there in Los Angeles as we await those results out of Netflix coming in just a little less than 24 hours from now. Katie?
All right, let's take a look at how markets closed on the day. The first trading day of this week. A lot of green on the screen. The S&P 500 up by more than 1%. The SOX, the Philadelphia Semiconductor Index, leading there. You can see it was up 1.6%. A big bounce back when it comes to those regional banks. We heard from Zions, of course, investors welcoming that with open arms. The index itself finished up more than 2% in anticipation. And the VIX, volatility draining with an 18 handle on your fear index. This is The Close on Bloomberg.
All right, let's talk about cruise lines, because cruise travel is set for its 4th straight record year of demand in 2026, according to a new report. The industry finding itself in the mainstream as more selective consumers seek a better bang for their buck in leisure travel. Our next guest knows more about it than anyone. He spent 3 decades at the helm of Royal Caribbean and is now out with a new book called Delivering the Wow: Culture as Catalyst for Lasting Success. Pleased to say that the chairman of Royal Caribbean and the former CEO, Richard Fain, joins us right now to talk a little bit more about that. Richard, great to have you. Great title to your book. And I do want to go back and start this conversation back in the late 90s when you joined Royal Caribbean, which was still a relatively small cruise operator, now one with $16, $17 billion in annual revenue, but who's counting? And I am curious as to what you thought about when you walked through the doors, or at least walked into your office as a CEO, and tried to sort of map out how you would actually grow this business. What was that thought?
Wow. Well, Romaine, first of all, thank you for having me. And as you say, this industry has grown by leaps and bounds over the period. 35 years ago, we were a small, very successful cruise line, but cruising was just a niche operation. And what's happened is cruising has become a mainstream part of everybody's vacation expectations. And as a result is that we've gone from being a really small operation at the edge of vacation to being one of the most valuable, if not the most valuable company in the vacation business, larger than any airline, any hotel, almost anything you can name. And it's because cruising offers such amazing value and such amazing time for our guests.
Was sort of the success, and not just of Royal Caribbean, but even a couple of your peers, was that largely due to the way that you marketed the product, or was it a little bit more organic? How did you get there?
No, I think it's not so much the marketing. It's what we offered was a product that appealed to everybody. We went from a product that appealed to a small, part of the total vacation market, mostly older or retired people. And now we have something for everybody. We have large ships, small ships. The ships are spectacular. It's really delivering the wow. I don't actually hate to. I like using the title of the ship, of the book. But we deliver the wow to our guests, and they love it. And the result is that people who come back from a cruise vacation don't just rave about it, they're obnoxious about it. I love it.
So it's interesting, Richard. I mean, you think about your tenure at the company, as Romaine said, over 3 decades. You were CEO from 1988 to 2022. Something big happened in 2020, of course, that global pandemic. And I have to imagine that must have been one of the more challenging parts of your tenure. Just talk a little bit about that time, because obviously any type of travel was really in the front line of what was affected.
Well, Katie, first of all, thank you for bringing back the worst time of my life and making me relive it. But you're absolutely right. It was a terrible time. It was a time when almost everybody we talked to said, this is an existential risk to your business. The likelihood is that you just won't survive. And everybody else we talked to said, okay, your focus has to be, how are you going to get through this? And I think what made us successful in getting it through it was we refused to do that. We said, the objective isn't to get through this. There's no point in getting through it as a crippled entity. What we wanted to do was get through so that we were strong and that we emerged from the pandemic strong and ready to grow. And that's, of course, exactly what happened.
And so when you left in 2022, I mean, you think about where the world was and what it felt like, and there were still a lot of doomsday predictions that, travel wouldn't return to levels that we had been prior to the pandemic, that, things had fundamentally altered. As you sit here in 2025 and you reflect on how you felt it when you left in 2022, I mean, how close are those two visions?
Well, actually, we did anticipate this. Yes, you're absolutely right. There were an awful lot of people who were predicting doom and gloom. The vacation business would never come back. But those people weren't talking to our guests. Those people weren't listening to the public. Those people were dealing with their own fears. We were dealing with the facts that what we were offering, and I love the pictures you've got on here, are just so exceptional. We were providing such an amazing vacation, and we were looking at our forward bookings. We were looking at our loyal guests. And so our goal at the beginning of the pandemic was to make sure that at the end of it, we were strong, that the product we were offering was extraordinary. And that's exactly what happened. The passion of our people was overwhelming, and they delivered the wow at a very reasonable price. And the result was predictable. The market has boomed.
I am curious right now, Richard, as to the current state of the cruise industry, and I mean it more from the side of the companies themselves with regards to being able to hire, and more importantly, hire the right people at the right price, and also, of course, getting your hands on the supplies and other materials that you need, particularly in light of some of the inflation that we've seen out there. What's been the process that you've seen with your CEO and some of your peers out there right now in managing that?
Well, actually, again, we're seeing a lot of people worried about, will we be able to get enough people? Will we be able to attract the guests? Will tariffs cause a problem with our supply chain? And I'm very fortunate that my successor in Jason Liberty has been an extraordinarily good leader. But we have over 100,000 employees, and frankly, it hasn't been a real challenge to hire them. Our goal, I mean, the whole book is about our culture, and our culture has made it possible to attract the best and the brightest. And we've had no difficulty attracting the people we need as we've emerged from the pandemic, and we've continued to grow at good rates. We've had very little problem on the supply chain side. It's a little difficult, but you know, there's always some challenge. But basically, we've been able to meet our needs without, frankly, we've been able to control our costs to a remarkable degree. So I think it's, again, one of the things where we shouldn't spend our time looking at people who write press releases who don't necessarily talk to the guests, don't talk to the supply chain. We should look at the facts on the ground, and we should have a culture. And the thing I'm proudest about in my 33 years was participating in developing that culture that creates the wow, but creates the wow not only for our guests, but also the supply chain people delivering what's needed to the ships, the crew members delivering what's needed for the guests.
Also with regards to those employees, and I'm curious just about longevity. I mean, you've been with the company for more than 3 decades, as CEO for 32, 33 years of that. Is that type of longevity normal for other folks out there, not just the CEO?
That type of longevity is not typical. CEOs, I think, in the United States average somewhere in the range of 6 years. And one of the beauties of being in that position so long, and I had the best job in the world, but one of the beauties was you get to work with people, you get to develop people. And so the top management at Royal Caribbean are all long-term. The average of an officer at Royal Caribbean is like more than 15 years today. And that means they've seen it all. They've been through different crises. Just like any other industry, we have our crises. 9/11, it was the Great Recession, it was COVID. But the culture helped drive us to find solutions to what the problems were and continue to look forward, not back.
Well, to that point, Richard, I want to reflect back on your tenure at Royal Caribbean. Like you said, you lived through a lot of different crises, and you lived through a lot of different economic cycles. And you think about where we are right now, there's concerns about the labor market. We know that consumers are really tired after years of inflation at these persistently high levels. I mean, thinking back on past periods of high inflation, was it like managing through that, and what experience, how would that experience inform how you would handle this period where, again, inflation and prices just seem stubbornly high?
Well, I do think, in coming back to Romaine's point, I think the fact that we all have lived through this before and have the experience, and so we have the confidence to be able to look long term. Everybody else is looking at next month, next year. We have the ability, because we've all been through this, as you say, so many economic cycles, so many other kinds of crises, to know that you do emerge on the other side. Now, we're benefiting in the cruise business because not only do we provide a fantastic vacation, and by the way, I'm happy to sell a cruise if we can get to that in the program, but if I can't sell you a cruise, I can point out that the cruise is actually a good value. So what we've seen in recessionary times is the cruise industry doesn't suffer as much as some other industries because we're good value. And during bad times, people don't stop vacationing. They just are more careful about what they choose. And when they look at us, they find it's good value for money. So that experience, the culture of everybody aligned to a long-term goal, those things have gotten us through in the past. And I feel very good about where they're getting us to today.
All right, Richard, great to get some time with you. That's probably a good place to leave it. That is Royal Caribbean Chairman and former CEO Richard Fain, the author of the new book, Delivering the Wow, Culture as a Catalyst for Lasting Success. You take a look at the cruise landscape. Royal Caribbean, a market cap of $82 billion. That is more than the market cap of Norwegian and Carnival combined.
Yeah, and it was like, I was going back, I mean, like flipping through his book, and you go back to what the industry was like back in the 70s, and it really was a niche industry.
Yeah.
And now it is on par with, you know, your Marriotts and your Disneys, and, you know, you pick another, you know, major travel company, and they're basically right up there.
Have you been on a cruise?
Not yet, Katie Greifeld.
Me neither.
Yeah, water.
No.
All right, when we come back, we're going to set you up for what to watch over the next 24 hours. This is Bloomberg. All right, here's what the markets are going to have their eyes on over the next 24 hours. It includes quite a bit of earnings.
Yeah, absolutely. GM, General Electric, Coca-Cola, Lockheed Martin, the list goes on. A real smattering of industries.
Northrop Grumman, 3M. Don't cut them short, Katie Greifeld. But after the bell, we got some big ones that we're going to be covering here, including Texas Instruments and Netflix.
Netflix, that, of course, will be right in the market's eye.
Capital One and Western Reliance. Don't cut them off, Katie Greifeld.
I'm sorry. There's just so much going on. The good news is there's no Fed speak. We are in a blackout.
All right. But we are going to hear from the ECB president.
All right.
No blackout there. Full coverage tomorrow, right here on Bloomberg.